Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, Head of UK Rate Strategy, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Okay, I'm going to start with the Bank of Japan, which isn't a topic that we often discuss on this podcast, but I think it was probably the main event on the calendar this week, even though perhaps in reality it turned out to be less exciting than we were expecting it to be. So how did that really affect European rates this week, Giles? And how are you thinking about the Bank of Japan going forwards?
Pretty much as you would have expected, I guess. It was taken as a bit of a bullish signal. It doesn't take a lot at the moment for the market to see bullish signals in pretty much anything, I think. So it was followed up with a pretty big rally, big flattener as well, where we had a big long end flattener in particular yesterday, in fact. Above all, I think it was just another squeeze on what was basically an attempt by the market to have a go at an apparently thematic asymmetric risk. And there are big themes out there this year, but big as they are, timing matters. And I think the market got a little bit excited about this, perhaps. On the other hand, who's to say what would have happened if the Bank of Japan had actually surprised and removed some accommodation. But broadly speaking, it's I suppose it's back to the squeezy environment that we have seen so far.
The environment we've come to know and love in January. Okay, Jan, how about in the US then? We've seen a bit of curve flattening that Giles was mentioning at the front end of the curve. Is that Bank of Japan driven, or have you also forgotten that it was the Bank of Japan earlier this week?
Yeah, I was following the reaction post Bank of Japan, and of course we did get a rally in rates, kind of what Giles mentioned right after the announcement, which was a lack of any action leaving the yield curve control as it was without changing the parameter. So, but yeah, did we get a rally? It was about a 9-10 basis point in kind of like the 10-year point, which should have been the focal area where investors would have expected the steepening to happen if that happened, or the sell-off. But that being said, immediately after the announcement on a kind of more, I should say, relative value measures like 5s, 10s, 30s type of flies, 10s outperformed only by about 3 basis points right after the announcement, which kind of brought it back to, the spread back to the levels earlier in the day. So almost like a big nothing, like it wasn't, markets really weren't that shocked by the lack of announcement, I should say, in the US. But we did get, of course, some flattening on the Bank of Japan. I should say I would have expected some more rather than what we got, but I suppose markets were really not willing to bet the house on that one. So yeah, kind of similar to Giles, not too much, but on the other hand, I guess if they did increase the band or it went all the way through and abandoned the YCC, then it could have been a much the steepening, I should say, of the curve, but we didn't get it.
Yeah, I just wanted to say that, this is going to come back, right? I don't think that the Bank of Japan has gone away as potentially one of the biggest drivers this year. But having been stung, I don't think people are going to want to re-engage with it. We will have to see what the new leadership looks like. We'll have to see what that wage round in the spring looks like, and we'll take it from there. But no, I'm very confident that the Bank of Japan will be tightening policy in various ways this year, and I think it will have a pretty big impact, but we'll have to come back to it.
Okay, so perhaps then, Jan, you might have, with the Bank of Japan for this week in the rearview mirror, you would say that perhaps the data had been a bigger driver in the US actually probably really of global fixed income, but let's focus on the US for the moment. What was the important data this week, and how does that change or reinforce your Fed view?
Right. So the Bank of Japan was the first part of the Wednesday sequence. Going into that, we had retail sales and PPI announcements, both of which surprised, retail sales to the downside and PPI also to the downside. But I guess the downside surprise in PPI is a welcome one. So what happened was we saw actually the front end remaining pinned because it is, after all, the Federal Reserve Board keeps maintaining that they will keep rates where they are by the end of the year. Whether that happens or no is to be seen. Our expectations that we're not going to get cuts by the end of this year, but it might be hard to persuade the market that we won't get any. In any case, you're not going to see this like a cliff dive of rates in the next few months, which should help support the front end a little bit. And if anything, the front end is also pretty prone to getting jawbone, I should say, by kind of like, for example, Powell coming out and saying, well, we have a lot more to do, or a simple comment that could lift front yields higher. However, as soon as we got the weak retail sales and the lower PPI, the belly of the curve, so like 5 and 7s were the point where the outperformance was most exaggerated, and that portion of the curve actually did steepen. So like the 5s, 30s, and that's kind of your maybe like bad data recession trade, because you have your front end more or less dependent on the Fed, and then for a little bit further out in the curve, you're reacting by expectations of more and more cuts to become. I do get the question of whether the market is pricing a hard landing or no, and I should say I still don't think the market's there yet. And applying like a pretty simple logic there, the Fed has the neutral rate at 2.5%. If you look at where the forwards are, the bottom comes in at like 2.8-ish. So your market's still not really priced in for data to get bad enough for the Fed to cut, to what they consider, loose monetary policy. So we're still not quite there yet of pricing a hard landing, but bad data this week certainly flattened things like 2s, 5s, but then but further out on the curve, we saw a lot of like kind of duration buying in like 5 and 10-year part, which were the stars of the day. So data was bad, economy is softening, but that being said, Q4 should still end in a pretty robust path to finish with positive growth and positive consumption. It is to be seen for the first half of this year. And US had some data, but like you said, data has been driving a lot around the world this week too. So it was a big one for UK as well. So why don't you talk a little bit about that and what we learned?
Yeah, so it's the big data week this week for the UK. We'll get retail sales after we've recorded this, but the highlights so far, I guess, will have been the labour market data and inflation. They mostly, to be honest, came much more in line, I suppose, than the data in the US did. So in some ways, much less exciting. But I think this week, perhaps more so than other months, this week's data was important, given that it feels like there's still an ongoing kind of live discussion about whether the Bank of England are going to do 25 or 50 in February. And there's not much now on the calendar in terms of scheduled Bank of England speeches. Or interviews or anything that will give them the opportunity to kind of steer market expectations one way or the other. So it felt like this week's data carried a lot more weight perhaps than other months do. And to the extent that you were, looking for signals to push you in either the direction of 25 or 50, I'm not sure there was anything there to move the needle if you were swaying one way or the other back in the other direction, to be honest. If you look at the labour market data, if you're in the 25 basis point camp, I suppose you'd point to a kind of softening in the activity data. But if you're in the 50 basis point camp, I don't think they're going to do 55. If you're in the 50 basis point camp like we are, then you're probably looking more at the average weekly earnings data and the wage inflation data, which seems to kind of reinforce the wage inflation expectations data that we saw in the Bank of England's decision maker panel survey published just a couple of weeks ago, which showed a big rise in wage expectations over the next year. And similarly with inflation, we had CPI inflation that came really exactly in line with expectations. RPI was a little bit softer than expected, but still some stickiness in core inflation. And so if you're in the 25 or 50 basis point camp, there's probably something for everyone there. But overall, our assessment is that this stickiness in core inflation, this still kind of quite persistent wage inflation. And don't forget that that's what Hugh Pill really highlighted in terms of what they would be looking out for to understand the persistence of inflation and the risks of second round effects. He was quite clear that wage inflation would be a key indicator of that. that. So to the extent that price pressures are still building in the UK, that I think is going to matter for the monetary policy outlook. So a combination of that and some decelerating, but perhaps not as fast as the Bank of England would like from a very elevated starting point inflation, I think still means that you're expecting 50 basis points in February. The market has slowly moved that way. We've got a couple more basis points priced in this week. I think probably at the time of recording about 45 or 46 basis points priced for February. So still a tiny bit of juice left in the trade there, but I guess risk reward here, given that it's probably a non-zero, not a zero chance that they go 25 in February. That looks roughly fair. The market pricing that I would push back more against for the Bank of England is just the cuts that are being increasingly priced at the back end of this year. So we've now got about 15-ish basis points of cuts being priced from the peak rate in August to December, which feels high to me. That's the market saying that they think there's a more than a 50% chance of a 25 pip cut in the back end of this year. And it's not that we don't think that risks might be skewed more towards cuts eventually, but that's probably not until 2024, and a still quite elevated inflation profile we think will at least keep the Bank of England on hold through the rest of this year. I guess it would be a little bit remiss of me to talk about inflation and inflation expectations this week without also mentioning gas prices, because I think they've been a big driver of market moves in both Europe and the UK. And potentially a driver of one of the big headlines this week, which was, around this ECB sources piece that they might not need to do another 50 basis point hike after February, and they might be stepping down to 25. What's your take on, I guess, gas prices in Europe, Giles, how much they matter and really how relevant they are for the ECB? And perhaps you can also throw in there what you think about all of the ECB rhetoric that we've got this week.
So just thinking about the lead up to the February meeting and the data that we have between then and now, we have data that in principle should matter, right? We've got PMIs, we've got the IFO, we've got inflation data. The inflation data comes out in the blackout period. But again, going back to the impact of gas prices, I think that probably underpins a reasonably good outcome on the growth indications from the business surveys, the IFO and the PMIs, and then for the CPI flash, which is just before the meeting, we and consensus have core unchanged at 5.2%. So I don't really see them changing their rhetoric in the next meeting. So I really think that everything hinges on what the data looks like coming out over February and how that feeds into the forecast round for March. But as I say, I think that roughly 50-50 for that March meeting is probably about fair at the moment. In the UK, you've been doing quite a bit of work yourself, Imogen. So maybe you can just tell us about what your conclusions on the inflation side, and also on what you think that the implications are for gilt supply, because obviously that's been a real focus for investors as well.
Yeah, I guess, going back to what you said about it driving a lot of market sentiment in Europe, definitely the same has been true in the UK. It's driving a lot of market sentiment, particularly around the inflation outlook, but I suppose also around a slightly better growth outlook as well. On the inflation side, I guess the points here that I would make is just not to get too carried away about what today's lower energy prices imply for very near-term inflation. The government's energy cap is set to raise in March to £3,000, and that is still below where the off-gen price cap would be in that quarter. So the cap still holds, if you like, for the first half of this year. It's only at the second half of this year where we're now starting to see, given the way that energy prices have fallen, the possibility that actually the off-gen price cap will fall below the £3,000, the government's raised price cap in March, which obviously has downside pressures on inflation. But even accounting for this fall in energy prices that we've seen over the last couple of months, plus the new information that we got this week with a slightly lower RPI print than we were expecting, we still see RPI at the end of this year above 4%. And that is using the updated estimates for the price cap, which Cornwall Insight, a kind of think tank that have been pretty accurate at estimating, sorry, not the government price cap, the Ofgem price cap. They've been pretty accurate at estimating that price cap based on the moves in energy prices. So using that as an input to our inflation forecast, we still get inflation above 4%, RPI above 4% at the end of this year. So that is still above where the market's currently pricing. I guess the big kind of move this week in RPI was at the front end, where we saw 1-year RPI dip below 4% for the first time in a year. So I'd push back marginally against that. I think that seems a little bit on the low side now, perhaps not as low as it might have seemed two weeks ago. But the second point is just that these prices are still very volatile. Cornwall Insight updated their own price cap estimates 2 weeks ago, and that was about 2.8k for the second half of this year. And we've now had a 20% fall in that price cap in just 2 weeks. So a lot can clearly change between now and July. And Cornwall Insight also put a kind of range of estimates of what the price cap might be in the second half of this year on their blog, if you like. And using their kind of upper end of the range, which just accounts for a 10% increase in prices, you get an RPI print, which is actually closer to 5% than it is 4% at the end of this year. So there's a lot of volatility and a lot of sensitivity on that number to what that price cap might be in the second half of this year. So I would just caution against reading too much into today's low energy prices for the outturn for the end of this year. And the second point I would make there is just with regard to the Bank of England's reaction function. I talked a lot earlier about what we expect the peak in rates to be, and that we'd push back against this kind of cut narrative in the second half of this year, but also that the Bank of England have long considered the EPG. Their own assessment is that the EPG, the government's price cap guarantee, to be kind of near-term dovish, in that it eliminates that price spike in the near term and the impact on inflation. But over a longer time horizon, over that kind of 2 to 3 year horizon, which is the more policy relevant horizon, there's actually a more hawkish impact, because you start to see, inflationary pressures build from other parts of the basket. So that discretionary spending that would have been spent on energy is spent elsewhere. And whether you get that kind of artificial effect from a price cap or from energy prices themselves falling, then there is still that kind of more hawkish long-term effect. So I would just caution against markets expecting, again, too much of a kind of cutting cycle in the second half of this year, and reading across too much from a very volatile short period in markets. The final point I would make, Giles, is what you highlighted at the beginning with regard to supply, because I think, I don't think listeners of this podcast need me to reiterate how important we think gilt supply is going to be this year for gilt yields. But the important part of the narrative here is that actually, whether or not the government's price cap goes, in terms of a cost perspective, goes to zero, because wholesale energy prices ultimately converge to that level, and at the moment are projected to dip underneath that level, and therefore, cost the government nothing to cap prices at £3,000 next year. The total cost of that cap that the Treasury estimated it to be in the autumn statement for the next fiscal year, 23-24, is only 13 billion. So even if the cost of that cap falls to nothing, even if by April energy prices have already fallen below the government's price cap, the total savings available is only 13 billion, which, when you compare that to a gross gilt issuance outlook for the next fiscal year of 300 billion, it seems slightly insignificant, especially when you consider that a lot of those savings may well be recycled into other, public expenditure anyway. So I don't think that this is a real game changer for the supply outlook, and markets shouldn't really be trading it as much. Obviously, if we do see a sustained fall in energy prices over the next couple of months, that could be a game changer for the inflation outlook. And I think that will be very relevant. But I just think markets need to be careful not to overestimate the disinflationary impact of the moves that we've seen in just a short space of time, especially when you consider that actually there are still risks probably to the upside as well when it comes to the energy price outlook, when you consider the kind of potential geopolitical risks and the impact from China reopening as well. On the subject of supply, then, let's do a quick stock take, because I do think that that's been a kind of key theme for us this year. Giles, how are we looking in Europe? We're now in the third week of January. It would appear, if you just look at the level of rates, that supply has been relatively well digested so far.
More than that, I would say. It's clearly been very well digested. No, we have had, I would say, very heavy supply on any historical measure. I mean, certainly in volumes, PVO1 is down a bit, but that's just because that's mainly because rates are higher, and so the PVO1 delivered by the bonds is just a little bit lower as a result. But I mean, I think that the performance in credit in particular says it all, really. It's been tightening relentlessly. Credit funds have seen pretty strong inflows, and by and large, I would say it's difficult to see exactly what the dark clouds ahead might be. I mean, of course, if the economic data sours, then that would hit sentiment. There's no doubt about it. And I think that there is also a sense around the place here that indigestion is a difficult thing to really to have your finger on the pulse of, because it can kind of creep up on you, and we saw that last February, for example. It's not impossible that in a week's time or 2 weeks' time, investors will they'll sort of update a spreadsheet and go, oh, actually, no, we've done quite a lot, haven't we? And then they'll end up backing off. So I think this is just maybe something you'll need to ask me again next week. That said, I do think that given the rally in spread and yield levels and spread and rates, maybe we ought to be looking out for supply to be increasingly bought hedged rather than outright, and so maybe that's a bit of a risk for swaps, for example. Asset swaps have been doing very well in line with credit as a sort of credit proxy, but I think there's maybe a question about whether that dynamic is changing at lower rates, for example. I'm also maybe just as a mental note for next week, we're in the process of updating a credit kind of pack at the moment, and in there's a little model for implied default rates, and I think that that could be interesting to discuss as well, but for next week. What about your side? In the UK, is it? I mean, I guess it's been a little bit slower there. Is that fair to say?
Yeah, I think we got off to a slower start than Europe, certainly. Well, from a DMO perspective, obviously we got off to quite a quick start when it came to all the QT, the long end QT that was done in early January. But generally speaking, we've had a couple of slow weeks of supply, but I think that can change next week. We obviously have the syndication next week, the long end syndication, the new 53. And that's the kind of start of a couple of heavy weeks of supply, particularly given that after next week, we will then have long end bonds added into the regular QT auctions. So they will begin on the 30th. And then we'll have, compared to the shorts and medium buckets, we will have a couple extra long end auctions to try and catch up, if you like, for these past few weeks where the Bank of England hasn't been auctioning long end bonds. So it's been a slow start, generally speaking, but I do think that next week is kind of the beginning of a couple of weeks of relatively heavy, net DVO or net duration being issued to the market, and that should continue really for the rest of this year. That's a dynamic that we expect to continue, and if we do start to see more signs of supply indigestion perhaps as the weeks go on in Europe as well, then I think that can start to weigh more heavily on gilts than it has already. And Jan, for you, I guess the debt ceiling, if we're talking about supply, we should mention that as well. That's been kind of back in focus this week. What's the latest there?
Yeah, the debt ceiling really picked up steam after Treasury Secretary Yellen sent out a letter to the House of Representatives saying that the U.S. has effectively now reached the statutory limit of borrowing. And so, there's really two ways to deal with the debt ceiling. You either postpone it to sometime in the future, give it like 3 years of suspension, or set a specific number from where we are and say, for example, we have 3 more trillion of room to borrow. That's basically what happened last time about 2 years ago, and now we've reached that limit. So what does that mean? It doesn't really mean that the U.S. is on the brink of default by any means, and by what you would just kind of quickly gather from reading some of the headlines. What it means is there's a couple of steps before a default, which I should say hasn't really happened in this in the sense that we're talking now, pretty much in modern U.S. history, excluding some like delays in payments and whatever. But so what does that mean? The Treasury now announced what's called a debt issuance suspension period, and they will use extraordinary measures. That they're accounting gimmicks mainly to open up room under traditional debt issuing, because Treasury issues marketable and non-marketable debt. For example, marketable debt is what we talk about in this podcast, things like bills, bonds, notes, and everything that you can really buy and sell on the open market. But there's also a relatively chunky part of the U.S. debt that is the so-called non-marketable issues. And there are things like civil retirement pensions have specific issues that are created just for those funds that mature on a daily basis, and Treasury will reinvest. So type of securities that you and I can't really buy, but they do count as part of U.S. debt, and they are used to fund various things like some form of future expenditures for the U.S. So what's going to happen now is our estimate is that we're going to get about 350 to 400 billion of headroom by using these extraordinary measures. So what we're going to see is less issuance in this non-marketable side, with the promise that once the debt ceiling debacle is resolved, Treasury will make them whole, and more issuance on the marketable side that are used to pay normal bills like interest and Social Security and Medicare and Medicaid and everything else. In the meantime, for Treasury supply, that means a wave of Treasury bills that are coming in. Treasury's motto is not motto, but like MO usually is not changing longer dated issuance, keep them regular and predictable, while the fluctuations in cash flows are usually met by adjusting the bill issuance. As far as sizes go, we think from mid-January until the end of February, we're going to see about 300 to 350 billion of new bills coming to the market, which is a substantial chunk of new debt or new short-dated collateral that will come into the market. That will take some from the RRP facility of the Fed too. That should push a little bit. That should add a little bit more upward pressure to front-end rates like SOFR, and generally should help cheapen Treasury bills against swaps and comparable funding rates. Once we get, and the next step after that is March, when we kind of enter the purview of the April tax inflows, which seasonally is a very strong month for cash inflows, because the April 15 being the tax deadline in the US, Treasury will start running down their bills mid-April and allow for pay downs to materialize in April, offset those cash flows. But in any case, there is still plenty of room to go for a default's really in question. We don't think anytime in the first half of the year, given the seasonality of cash flows and how much room we would have with extraordinary measures. And then if no decision has been made by then, maybe the second half of the year, kind of like August, September, is when we would start, fearing a real default. But my guess is, as it usually does, there is always a resolution. It might come through some concessions by the Democratic Party, but I wouldn't expect that to kind of spiral into a big default event. Or alternatively, we can just mint a platinum $1 trillion coin and kind of move on with our lives and bypass the debt ceiling rules and get on with it. But that's kind of it on the debt ceiling. Nothing to worry about for now. There's going to be some accounting tricks and more supply coming to the market counterintuitively because of the debt ceiling.
Okay, thank you, Dan. All right, let's stop there then. Lots to talk about this week, which is always fun, but I do think we've probably been talking for long enough, so we will let the listeners go. But just a reminder, if you did like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, see you next week.